where I'm extremely excited. Welcome to Candle Science Part 2, where I'm extremely excited to go over candle science entries, something we have not gone over just yet in any enrollment before this. And it's not because I was hiding something, that is purely because I'm a trader myself as well. So the more I trade, the more I study, the more advanced understanding of the concepts I use as well, which I then share. So right here, if we then move on towards the first slide where we need to go over, same as in order flow entries, those time frame alignments. We have the context time frame and we have the entry time frame. So the context time frame for the candle science entries right here is the following. If we have monthly context, we want to look at a monthly candle science entry. Again, we're also going to go over later on in different slides how we can use sort of different time frames as well. But as a general rule of thumb right here, what we're first going to start off with is any time frame that you have as your context time frame, the same exact time frame is where you are going to look at your entry time frame as well. So the weekly is the weekly, the daily is the daily, the 4 hours is the 4 hour, the 1 hour is the 1 hour, 50 minute is the 50 minute as well. So a lot of people might assume right here, well, this is then mainly targeted for people that want to want to swing trade, want to position trade, higher time frame trading. That's not true. And the reason that's not true is because I have been using this, and oftentimes my entries are better than if I were to go into the lower time frame in the 1 minute time frame, for example. My take profit is hit actually faster oftentimes than if I were to just go into the lower time frame as well. My chart time is a lot less. So essentially, I am scalping, I am intraday trading with the understanding of the other concepts that we also use. But I don't need to go into those time frames, which is, of course, the magical part. That is why I am really excited to share this, because this is, for me, a really good step forward. Now, how do we actually look at our entry then? This is where we need to understand the two candle rejection quite in depth again. So I want to refresh our mind on that two candle rejection right there. We have the first candle. The first candle visually rejects, or the first candle doesn't reject. We have two options right there. So right here, if the first candle rejects right there, then the second candle respects. So if the first candle visually rejects, second candle respects whatever the first candle was doing. It's just, if we are coming into this kind of way, first candle already rejects, second candle is going to respect that first candle rejection, already going to continue higher. First candle does not reject, so there's no rejection, or there's just not a clear visual rejection. Then the second candle can still sweep the previous candle low or previous candle high to then create the rejection. So, of course, it's way more beneficial to show you this in a chart. All right, so right here we are on GBP Canadian dollar. This line that you're seeing right there, that's a weekly swing high, which was the overall drawn liquidity. Now, moving towards that, we are creating certain context areas. So, order flow areas as well. Right there, we have the daily value gap, which we can continue higher off of. We have this daily value gap, which we can also continue higher off of. Then, towards the weekly swing high, we have this daily value gap, which we can also continue higher off of before we actually reach the swing high right there. Now, there's different types of deliveries right there that we have inside that fair value gap, and you might already notice it. Where the first fair value gap right there, whilst we come into that, we have a visual rejection. What is the rejection and what makes that a certain rejection? The first candle that comes into this daily value gap right there has a long wick at the bottom. So we can see where it opened up. It opened up quite high. It is a long wick at the bottom right there, stinging into that fair value gap to then come back higher. So what happens on the lower time frame in a long wick at the bottom right there? On the lower time frame, there is something like this happening. What we also know as a sharp turn, or potentially our order flow confirmation, which we went over on our order flow entries. So one might seem superior right here, candle science or order flow, but that's not the case. The other can't live without the other. Candle science would not have been in existence if I did not understand order flow. Everything is based off of order flow. Now we are just looking at order flow on a higher time frame premise, meaning I'm looking at order flow through a singular candle. And that makes it so extremely advanced and so extremely powerful as well. So whenever we have the first candle rejecting a visual rejection like that, and if you struggle with the visual rejection, I do not want to make this objective. And the reason I do not want to make this objective, a trading plan consists of the following parameters. We have 80% of our trading plan, which we try to make as mechanical as possible. Those are our guidelines. So when we go into the chart, we actually have an understanding of what step we now need to take next. Then 20% right there is experience, is intuition, is subjective. That is where you are simply building up your experience to understand, hey, I've seen this situation before. I think this is going to play out. I can't really explain why, but I just have this feeling that it's going to play out. That's intuition. That's based on experience because you've seen hundreds of examples before that as well. So that rejection, I don't want to make that completely objective because if we make a trading plan 100% objective, it's not going to work. That's where people try to code it, etc. Whilst there's a lot of variables going into it. So if you're, I've not come across it myself, but if you're an extremely advanced coder and you can code every single little detail, well, then it might be possible. But overall, if you are looking to trade yourself, you want it to be 80% mechanical and 20% subjective. And I've also been in a position where I tried to trade 100% subjective. Also does not work because then you're mainly trading off of emotions. You think, oh, we're going higher, we're going lower. You don't have any rules which prevent you from doing something stupid. So to 80-20 rule, that is the percentage, the parameters that we want to have. That 20% though, that 20% is the potential. That is where your trading plan, your trading strategy will excel. That is where, if you build enough experience, if you build enough intuition, your win rate will increase significantly. Your RR return will increase significantly. You will prevent certain losses where other people that only have or that don't have that experience just yet, they won't prevent that. So sometimes you'll see me say, whilst we trade the same trading strategy, you'll see me say, hey, I'm not going to take that trade. And you might take a loss. And it's not because I don't want to take that trade in a certain way or it doesn't fit my trading plan. No, there's just that intuition part, that experience part tells me right there, hey, that's not a good setup because of this. So that is extremely important to understand. So right here, if the first candle is visually rejecting, and if you want to somewhat make it a little bit more objective, a visual rejection, what is that? Well, this candle right there is in total 68 pips right there, where the top right there is 20 pips. And the bottom, the longest rejection side, is 47 pips right there. So the bottom wick is actually the longest part of that whole body and the top wick as well. So that is how we can see, all right, somewhat objective way of visually seeing that rejection. If the first candle rejects it right there, the second candle respects. Meaning, what is it respecting? The second candle is going to respect the first candle low right there. If the second candle respects, because it's just a game, as in we follow through on every single candle right now. If the second candle respects and continues higher already, create an expansion phase candle ideally, because what is the objective coming out of a previous fair value gap? The objective is to create a new fair value gap on the same time frame as fast as humanly possible. That is what we went over in previous order flow videos, what we went over in the analyst month so in depth, because that creates, again, that new order flow lag higher right there. So if the second candle is an expansion phase candle, that's perfect. Then the third candle can now respect the second candle low right there. The fourth candle, can it respect the third candle low? Well, now we have created a fair value gap right there. So we would have to see, is there an actual chance that we trade back into that fair value gap right there? Well, that is where you can apply the same thing that we just did with the rejection understanding on that third candle. That third candle right there has a long wick at the top. That's the only rejection it has. It has no real rejection at the bottom. The rejection at the bottom, we could count as this right here. the body, because that's an up candle, and the wick as well. So that's 29, 28.9, let's say 29. Then at the top wick, we have 32, 33 right there. So what is happening? Well, potentially this is happening. We had a move lower, we had a move higher right there. But as soon as we had that move higher right there, what happened? We saw a huge rejection coming lower again. To do what? To potentially now trade back into that daily Verwijk gap to then continue higher off of that again. So that third candle is actually not protected right there. So the second candle is still protected right here. But what happens after that? We sting into this and we have a new rejection. Again, a visually clear rejection right there. Where now we can look to continue higher off that. This is now the protected low. After that, what can we say? Well, we can say this is the protected low right there. Okay, it doesn't become protected right there. Why not? Well, are we running into a certain resistance? If that's the case, then we could argue, okay, that down candle, we could have seen that coming. Sometimes it will just simply happen right there that we do not already continue higher. Here we had no resistance towards the highs right there. So I would argue that at that moment in time, I would also not expect this down candle right there. But if it does happen, perfect, we can simply wait. And if we wait, we now create this fair value gap overlapping with the fair value area that we just took as well, sitting right there. So what do we now see? We have first candle coming into that. First candle does not reject right there. Okay, well, does that mean we are disrespecting everything and we are going to continue lower? No, oftentimes that means that during that candle creation, so during this daily candle, so during that day, we came into that daily Verwijk gap late during the day. Late during that daily candle creation, which is of course just late during the day. So that means we don't have time anymore. We don't have the time left over to actually create a rejection higher. We don't have the volatility left. We don't have time left over to actually create a rejection right now. So the rejection, if it still wants to reject, will happen the next day. Understanding the unmitigated and the mitigated PD rates right here, every PD rate that we already trade into is invalid right now. We do not trade off of those. Yes, of course, still with the understanding that this is the context right there. Fair value gap towards this potential swing high right there. Now, if we are looking to continue higher, we are not looking to continue higher off of this fair value gap. Bigger picture, yes, of course, but the boundary there is gone. We need to find a new boundary for our entry, and that new boundary for our entry is the previous day low right there, since it's a low close. So we are leaving behind a discount array, which is the previous candle low right there, to then sweep that liquidity to then reject higher. So right here, the same story repeats, but since the first candle does not reject, the second candle can reject. And if the second candle rejects right there, third candle respects what? Respects that low right there. And we can even, again, it's all fractal. And this is so beautiful in my opinion, because right now we can refine that where we want to respect what? Well, what are we sweeping? We are sweeping, again, understanding those breakout trades on the lower time frame. Remember the analogy we used and how we could refine our stop loss a little bit in the order flow entries. Right there, we should respect this low right there. That first candle low that didn't reject. Why? Because if we are coming back below that, then we might not be sweeping those people actually, and we might actually want to run that liquidity and continue lower instead. So this is what we can refine a little bit. So we can get our refined understanding of what we should respect right here. Now, after that, we see we continue higher and we reach the target. So until we reach the target, that low is protected. But after we reach that target right there, our overall context drawn liquidity is gone. Seems like we might be sweeping that high instead. So we want to be a little bit more careful. That's where we want to take a step back. So also the important thing here is every rejection that I'm looking at right here, it's extremely important to understand the PD rates that I'm actually trading off of. I'm not just picking any PD array. I'm not just picking this PD array to continue higher off of, because this PD array in comparison to the other PD rays is extremely low probability. The flood is not a fair value gap. The flood is actually this order block right there. We have just reached major liquidity, which it seems like we might be sweeping. There's arguments going against it. So that is where you don't want to use a concept like this. Well, yes, potentially, but not to look at longs right there, to look at shorts instead, to see if we can continue lower right there, purely based on the signs that we already had. Now, there's a lot of different variables, because even with this previous candle low right there, a 2-candle rejection can be applied to every single PD array out there, every single one. So if we're respecting that previous day low right there, first candle rejects, okay, sweeps and closes above again that previous day low. Second candle can then continue higher. The second candle respects right there, then the third candle can also respect higher, create a new value gap, targeting again this swing high. There's so many different variables. You can get extremely creative with it. And again, be creative with it. I don't want you to feel like you have to stick to my exact boundaries, stick to my exact understanding. Develop your own understanding. That will take you so much far further than if I just tell you something and you try to copy me in the exact same manner. If you take the concepts here and you take the understanding that I have from it and then build your own understanding by doing case studies, you will be so much better than I am as well as a trader. You will be so advanced in your understanding. It's insane. So that is 2-candle rejection. How do we now capitalize on that? Well, right here, if we want to capitalize on that, all we now need to do, and I'm laughing a little bit because it took me quite some enrollments to get to this understanding, whilst it's just right there in front of me, because we have had the understanding of candle science from enrollments that are not even on the current website, that are on the previous websites that are extremely old, from 2023, beginning of 2023. And that's where you mentioned this rejection, the 2-candle rejection, not that in depth. But all we now can do is we can now add the understanding of an order to it. So you just buy or sell. So right here, if we want to buy and the first candle is already a rejection like this, then what do? We place our entry right there. We cover the rejection. What is the rejection area? It's right there. And we target our 1 to 2, whatever we want to target to something we're going to go over on later on. Now, right here, if we want to enter this second candle right there, then we can also do that, because the overall drawn liquidity is still those highs, even this swing high that we encounter first. What is our stop loss? Our stop loss is below that rejection right there, because we should now respect that low right there. Target 1 to 2 right there, perfectly fine. And then after, we have this fair value gap. We can enter off that. Do we want to enter off that third candle creation? Not necessarily. Let's wait, right? It's a tricky third candle. We can have an understanding of what the third candle potentially wants to do, but ideally just wait. Right here, we sting back into that. We reject already. What can we do? That first rejection right there, perfectly fine. A 1 to 2 is sitting right there. And can you see how extremely small actually the area of the 1 to 2 RR is right there? It's not a crazy 1 to 2 RR area, as in you're not holding this for weeks or for months or for something like that. No, it's almost like you're scalping the daily time frame, which is beautiful. This is so extremely advanced. Now, right here, if we want to continue higher, we create this new daily fair value gap. Again, we are just simply looking to trade off of context areas, right? So this is context area on the daily, but instead of going into the order flow entry on the lower time frame, we are sticking on the same time frame right there. Where here, if we are looking at the same time frame, what do we see? We see this context area, where here, first candle does not reject. Second candle is what we wait for. Enter at the close of that candle, cover the low of that candle, because that is where we are going to respect, targeting a 1 to 2 sitting right there. This 1 to 2 is still perfectly fine because we have no resistance until we reach that weekly swing high right there. So even though the target is not in the context, that's perfectly fine right there with this type of entry. Now, again, you need to be visually clear on what an actual rejection is. So some things or some people might not like this trading plan a lot because it's not a clear mechanical approach, which I can fully understand. So just go with the one that resonates with you. Find the aspects that resonates with you and then stick to those. So right here, for example, we have this daily Vivaia gap right there. That first candle, for me, and again, it's hindsight, yes, but for me, and that makes it hard to explain because it's the experience, it's the intuition part. The only way I can explain it is it's not a big rejection if we compare it to the up candle. The up candle right there is 49 pips. The rejection area, the rejection phase, is only 10 pips right there. So that's the only way how I can explain it to you currently in an objective manner. I might think of it later on, but right here, that is just not a visual, clear rejection to me. So this, for example, would not be an entry to me right there, covering that stop loss, because it's not a clear rejection. I want to be absolutely certain, without a doubt, that we might come back towards that candle right there. So same for this candle right there. Also not a clear visual rejection for me to actually cover that high right there to then continue lower. Yes, if we want to enter this, we can do that, but our stop loss needs to be above a next premium rate, for example, and not actually above the candle high right there, because we might still sweep it to then continue lower. That is too tricky if we do not understand what a clear visual rejection is. So if you struggle with that understanding as well, then this might not be for you. So right here, if we now return to our PowerPoint slides, we have a good understanding of what the two candle rejection is here, right here on the same time frame. So keep that in mind, right? We were looking at the same time frame. So we were looking at daily context and daily two candle rejection right there as well. Now let's move on as well towards the next understanding, because you can, if the understanding is good, and that's the boundary right here. If the understanding is good and you don't struggle with that same context, same entry time frame, understanding of seeing that clear visual rejection, then and only then you can move on towards this understanding. And it's the same with the order flow entries in the previous video. If you understand the first ST plus RE good, only then you can move on towards only ST entries. So that's extremely important, where the first approach is the safer approach. But once you're getting comfortable and you find the safer approach quite easy to see, then you can test yourself, because if you test yourself, then right here you can get to such a more advanced understanding, which will pay off a lot more. But this understanding won't pay off and will only hurt you if you do not have the first understanding of the comfortable, the easy approach. Because this right here is more trickier as well. If you do not understand in order flow entries the ST plus RE, then the ST entries will absolutely burn you. They will blow your account. They will not be good for you. If you do not understand here with candle signs entries, the same entry time frame, the same context, so same time frame entry essentially, then going into this right here is just going to burn you, is going to blow your account. So I think you understand the point. Now, moving on, we have monthly, and now we go down a singular time frame to see the two candle rejection. This is also the maximum that we use. So with two candle rejection, you want to go down a time frame, and that's the maximum. You want to go, if you struggle with two candle rejection, stay on the same time frame. But if you want a more advanced understanding and more detailed a little bit, then you can go down a time frame as well. Where here you could use the monthly and the weekly right there. Weekly being, again, in brackets, that's the entry time frame that we're looking at. And the top one is the context time frame that we are looking at. Then we have weekly and daily. Then we have daily and 4 hour, 4 hour and 1 hour, 1 hour, 50 minutes, and 50 minutes, and a 5 minutes right there. So let's look at a few examples. Right here on Euro US dollar, if we zoom out a little bit towards the weekly and we understand the weekly drawn liquidity, we have this weekly fair value gap right there. Then on the daily, we actually had a very interesting scenario. And I've not gone over this just yet, but it's actually a trade that I took myself as well, which I'll share in a trading model in a different video later on as well. But I first wanted to get to this understanding before I shared anything differently right there. If we want to deliver into that weekly value gap, then when the weekly opens right there, what do we actually see? We have this daily value gap right there that could help us to deliver into that weekly value gap. And there it's a little bit tricky. We could still continue higher, still continue lower right there. It's a bit tricky right here. So on the 4 hour, what do we do? Well, we can do the same exact thing right here, just a time frame below it. But what you need to be more careful of course, if you go down a time frame, there's more price action attached. So the further the time frames are apart from each other, again, the more confirmation you are going to need. Meaning, if it's the daily and the daily, you can confidently say if it's somewhat of a rejection on the first candle, perfectly fine, we can already enter that. If it's somewhat of a rejection on the 4 hour with daily context, you cannot enter that. You need to be extremely clear on what a visual rejection candle is already. So that's why, again, the first approach that we went over is the Cantu approach to get you going and to get you some experience, etc. Then once you have that under your belt, you can now get the more advanced understanding. And that is extremely important to understand. So quick reminder. Now, right here, this was the actual entry that I took right there, covering that high right there, targeting lower. So I actually let this completely run. And the reason I let this completely run is because what can you also notice with these type of entries that we went over thus far? You can go break even so extremely fast, where we could even refine our stop loss towards that high right there. This would be the 1 to 2 right here inside the context still. And if we want to target lower right there, we can simply let it run right there. Now, again, that was also me for testing how I want to approach that right there, which that testing results is what we're going to go over a little bit later on, because it's different from the order flow entries actually. So right here, this would now be a visual entry as well for the 4 hour right here on Euro US dollar. Crude oil is another example where we have this daily fair value gap right there, which we can sting into right there. And whilst we are also in the midst of creating a new daily fair value gap higher, which we could continue higher off of that right there. And on the 4 hour, what do we see? On the 4 hour, this was actually discussed in a live session as well. We have this 4 hour fair value gap right there, which we can continue higher from. Now, we can go into the lower time frame to look for our order flow entries, but we can also just stick to the same time frame right here, where we already have visually clear rejection right there, like this, for example. And then we can target the 1 to 2 or target the context high, which is the RR. We can see it's not super worth it. So we can potentially go into the 1 hour right there as well to see, all right, what are we dealing with? On the 1 hour, we already have a clear rejection with this first candle right there, sitting right there. And if we now cover that low right there and then enter like this and then enter or go for a 1 to 2, we can see that entry is a little bit more refined, a little bit more advanced, if you have the understanding of what a clear rejection is as well right there. Now, there was an entry that I took a while ago on Australian dollar, US dollar, which was the sweep of this low right there on the 4 hour right there. We got this sharp turn to potentially continue higher to now target this liquidity right there. And the understanding was as well, this is the last rejection right here. So above that, we will reject. Above this 2 candle rejection, we will reject. So if we look at the 2 candle rejection continuing lower right there, it's again, there's so many different understandings on this. That's what I meant with you can get so extremely creative with this. Because if you want to understand the resistance or the no resistance that we have going against us, then the 2 candle rejection here will also help us in that. Because right here, first candle reject, second candle can respect, creates a fair value gap right there. So this, can we now respect the fair value gap or the order block to continue lower? Okay, well, let's wait for 2 candle rejection to get taken out on both sides. If we want to continue lower, what should we do? We should respect this high ideally to then continue lower instead. So we should not trade back above that high with 2 candle rejection ideally. And we should leave behind a fair value gap. So we can already refine that area a little bit more. We should not trade back into that first area right there. And then what do we see? On the next candle, we do that. So here the 2 candle rejection is now flipped, where the first candle is already a nice rejection right there. So that could have already been an entry. But what I did at that moment in time is I was on the 1 hour time frame right here. And I actually looked whilst this expansion phase candle was forming. So it wasn't even at the close of the candle right there. Whilst this expansion phase candle was forming, was still information. And I remember we were already It was about 5 minutes left until the candle closed right there. And I entered somewhere along the lines of this. I refined my stop loss towards actually the low right there. Something, it was around there. I'm not too sure. You would have to look at the RDO trades section right there to see where my actual stop loss was. But I refined my stop loss, understanding as well candle signs right here on the 1 hour time frame. Because here, if we are going to create, and this is the thinking in advance, because I am not looking at what are we dealing with right here. No, I'm already thinking 5 candles ahead, where here, this is now an expansion phase candle of a new fair value gap potentially, where if we want to create this fair value gap, then that fair value gap will most likely only have a sting into it because we have no rejection anymore towards the left right there. So if we want to create a retracement, then a retracement towards this breaker is not relevant anymore. That is not where we want to see a retracement. That would even become suspicious. So that entry for itself is already an entry where I'm relying on this trade is going to run right there. Where here, if right now we want to continue higher, 1 to 2, perfectly fine, right there. And what do we see after? We just start running and running towards those highs because we have no resistance anymore. We're already thinking in advance that worst case scenarios, we do get a retracement right there into that fair value gap. Perfect. It's not going to be a deep retracement into it. So the stop loss doesn't need to be all the way below those lows right there. It just needs to be in a place where in worst case scenario, we might be retracing. And if we retrace into this area right here, then I don't even want to be in a trade because that's low probability for me. So this is an even more advanced understanding of that candle signs right there, what we talked about. Where if we look at the same candle right there or same time or time frame below it, 4 hour fair value gap, 1 hour right here, 1 hour first huge, almost disrespect candle right there. We could argue there's the first sign of disrespecting. Second candle right there, we see it is sweeping that previous candle low, exactly what we would want to see, to then continue higher. But at that moment in time, and this is why the advanced section is, you truly need a little bit more advanced section because you need to think things through. Right here, we do have a fair value gap going against us right there. So if we want to continue higher off of that fair value gap right there, or continue lower, sorry, off of that fair value gap, then we can still respect it to continue lower. But if we fully trade above it right there, like we did and with my entry right there, then that is actually a good entry. Where this first entry right here, while still having a fair value gap going against us, yes, it could work out, but that is a little bit tricky. Why not wait until we have that fair value gap fully overtaken to then look for an actual entry higher right there? And this is how you can get to an extremely advanced understanding with the same exact thought process that we just went over. You just go down a single time to get more details. But again, there is also a dangerous part about more details because more details can also be overwhelming a lot of times. So if you struggle with all those different details, then first stick to the easier approach. Now, right here, if we move on, we want to risk management right here. Risk percentage, I am again going to refer, but I am going to refer to the funded guide right there. And I'm also going to refer to a later episode in this spring enrollment as well. Then for stop loss right here, under or above, depends, are we bullish, are we bearish, above the rejection candle. So what you saw me do throughout this whole video, you saw me place the stop loss under a bullish rejection candle or above a bearish rejection candle. So that is exactly where you want to have your initial stop loss. Now break even right here is where price has no reason to return. Think in advance. You can go break even, and this is where the candle signs entries, they stand out because you can go break even so much earlier than you can go with an order flow entry, for example. So use that to your advantage as well. Take profit right here. For the take profit, I have multiple options because I have tested multiple as well. And to be honest, a 1 to 3 RR full take profit is very doable right here instead of a 1 to 2 RR full take profit. Then we also have partials at 1 to 2 RR and then to let it run. Now, the reason I have noted down 3 is because if you're just starting out, I would advise start out with a 1 to 2 RR full take profit. If you notice, hey, this is going quite well, let me gather some data on 1 to 3 RR right there, then move on to 1 to 3 RR full take profit. If you notice, all right, this is also going quite well, partials at 1 to 2 RR or 1 to 3 RR, depending on what your personal preference, depending on what your data tells you as well, which one is more likely to get hit, then depending on how much profit you leave on the table or not. If it's worth it, then partial at 1 to 2 or 1 to 3, and then leave it running until a higher time frame, no resistance target after that as well. So let's go over a few charts to understand this. Right here, we are on CHF JPY, and I actually also, on CHF JPY, I took an entry this week. What's this week? Yes, it was this week. Where right here on CHF JPY, what do we see? We have this daily Verwijt gap, which we can potentially continue lower from right there. Now, a very interesting thing, we have a 2-candle rejection right there already. We have Thursday and Friday rejecting. Now, this is why it depends again on, it's quite important to have an advanced understanding with this, because right there, it's the end of the week. So what does it also leave behind? A previous week high potentially at that moment in time. So right there, excuse me, we leave behind right there some liquidity at the end of that week to then continue lower off of that. Excuse me, it's not a previous week high. Leave behind that end of the week right there, the Thursday and Friday. So we come into that late during the week. We don't have that time anymore to actually make that significant move lower. So we will likely do it the next week. It gets delayed again. So it's the same where if the first candle does not reject, then the second candle can reject because it gets delayed, the rejection. So right here, if we still want to continue lower, we can still sweep those highs, which we discussed in the forecast, etc. It's a nice fake top as well, which we can sweep to then continue lower off that. All we need to do, we don't even need to have that understanding, because all we need to do is wait for a Verwijt gap continue lower. Where here on the 4-hour, we get a Verwijt gap lower. That in itself is already, like we mentioned again, already an entry, targeting this context low potentially, where right here, if this was an entry, you can cover that high right there. The 1 to 2 is easily achievable within the context. So even a 1 to 3 RR is not too crazy right there. Again, start off with a 1 to 2, get more advanced understanding, go to a 1 to 3 as well. It will be worth it, I promise you. Don't limit yourself towards that 1 to 2 right there. Extremely important. So right here, where do we want to go break even? Where do we want to place our stop loss? Our stop loss right here is again above the rejection candle. So if we are entering off that first candle, if the first candle already rejects and you enter off the first candle, then the stop loss is going to be on the same exact candle. So your entry and your stop loss is going to be on the same candle always. It's going to be on the close of a certain candle, and it's going to be at the top or the bottom of a certain candle. That's where your stop loss is going to be. Your break even is simply based on thinking in advance and which candles should be respected. So right here, remember when we talked about this high should now be respected. This high should now be respected right there. We should create a Verwijt gap ideally as soon as possible below this low right there, because that's the easiest thing for price to do. So if this high is already respected right there, then as soon as this second candle right there closes, this in itself is already a potential break even right here. You do not need to wait for this next candle right here. You can, again, if you want to be a little bit more conservative, if you want to be sure that you can go break even, you need to play around with this on your own as well. You need to see, all right, how can we actually go break even? When can I go break even? What's the data telling me? Are we preventing winners or are we preventing losses? Very important as well, which again, we will go over the trading model later on in this spring enrollment as well, using this exact setup. But the thing here is I'm trying to give you the tools so you can get creative in understanding your own trading plan. So if you do not want to copy my trading plans, that's perfectly fine. Now you have the tools to create your own trading plan as well. So right here, this is the entry break even. Well, it can sweep that high, but it's very unlikely that we will sweep that high actually. And if we now get a more advanced understanding of the 2-candle rejection again, then we are rejecting off of this area right there, or off that fair value gap that we are just running into. I remember that I was looking at it and we just reached that area a little bit higher, I believe. That area right there. We rejected off of that area sitting right there. And understanding the two candle rejection, well, if this first candle rejects right there, the second candle should be an up candle, which does not happen again. Perfect. So we are more likely to now target this low, which is where the no resistance area also gets sort of activated, and we can continue lower instead as well. So right here, we can already go break even as soon as we have no reason to return based on the candle highs after that as well. So a break even can be achieved very, very fast if we are looking at the 4-hour time frame right there, which of course, relatively seen on the same time frame, it is quite fast. If we look at the 15-minute, of course, it's not that fast because you're waiting for the next 4-hour candle to close. But relatively seen to the same time frame, it is quite fast that you can go break even. So this right here would be a trade ID. But if we go down the time frame, then in itself, of course, this right here can also be a trade ID, where if we have the more advanced understanding, this, for example, right there can be a trade ID covering that high, and the 2RR or even the 3RR, again, don't limit yourself because you can see how far the entry is oftentimes extremely accurate. So you, excuse me. So you can see how far you can take this as well, and you can target that 1 to 3RR definitely. Now, right here, this entry is the one I took right there. And the first candle, I did not enter on that. Why did I not enter on that first candle right there? This is not a visually clear rejection to me right there, that top wick. We could argue in hindsight, oh, that's a clear visual rejection. You should have seen that, of course. But no, I am quite confident in my abilities right there that this could have still very well sweep that high right there to then continue lower. So what do I want to do? I want to wait for a little bit more. I want to wait for a little bit more rejection. So as soon as we were rejecting right here and we were continuing lower, then I entered on this close right there and I covered this high right there. Same candle entry. So it's entry on the close right there on the rejection candle, and stop loss is going above the rejection candle that you are entering on as well. So at the top right there. Now here, what am I targeting? I was targeting a 1 to 3RR right there, a little bit lower right there. And that's where I got out. And when did I go break even? Well, I went break even extremely fast already. As soon as we had this down candle right there, that's when I could go break even. And that's when price has no reason to return anymore right there. So this is how you would go about a full candle signs entry using, again, stop loss, break even, and as well that take profit. So for the break even rule, to ingrain that into your mind, every 2 candle rejection, we are thinking in advance. So right here, we have the first candle potential rejection. Again, potential. Second candle rejects. Perfect. Second candle right there should not trade back above that high. Third candle rejects already. We should now ideally, in price action, we should ideally see a new fair value gap being created as soon as possible. So this right here, that high is not very reasonable, not very logical that we are going to trade back above that high. Now here it gets a little bit more difficult because now we have an up candle. So we could trade back above that high to sweep that to continue lower. Here we do the same exact thing. Once we have that new premium array, that previous candle high, which we continue lower from, we reject all of that. Same thing. Those candle highs should be respected to create a new fair value gap to continue lower instead. So based on that, it's also when you would go break even. This leads to the understanding of risk management in candle signs entries as well. Now, after that, we have important notes. Again, re-entries you can add onto a winner. So the whole thing we just went over as well with CHF-JPY, you can add on to that. As in, if you see the candles rejecting constantly towards that context and there's no resistance anymore, then feel free to add on to that winner. If the first entry, again, is break even. Very important. And first, if you're just starting out, I would advise just start with the original entry. Don't do any re-entries just yet. You can do that later on. Then context right here. Stop looking for new entries as soon as we take the context high as low. Again, speaks for itself. Already what we went over in the order flow entries as well. High probability PD rate. picking out a high probability PD rate is crucial. I am not just entering off of any PD rates that you're seeing right there. I'm entering off of high probability PD rates, which is of course, again, a crucial understanding to see how far can we retrace? Can we actually hold in this PD rate? It's not just any random daily fair value gap that I'm looking to enter off of. That is very important to understand. Subjective right here. The power is in the subjectivity. And again, that's what we went over with that 80-20 rule. Now, I also want to mention, I personally have noticed this to work the best on more so of the higher time. So 1 hour and above. 15 minutes, 5 minutes, 1 minute. Yes, it's doable. And it is 100% doable. And it still works very well if you combine it with an order flow entry. So with an order flow stop loss, not an actual candle signs stop loss right there. And placing your stop loss above a 1 minute candle rejection high, for example. That's not something I would do. I would use that more so on the 1 hour and above. And the reason for that, I believe, is because the higher time frame PD rates are just a stronger PD rates. So they will see more rejections. That is where the actual trading happens. Institutions are trading off of the higher time frame, not the lower time frame. So the lower time frame, oftentimes, what you'll find is in order flow entry as well, they can mess around a little bit, can get very messy, can get very confusing before we actually make the move higher or make the move lower towards to take profit. Which, to avoid getting stuck in that, is why we can use these entries, for example. That is where, and it leads us to the understanding of order flow versus candle signs. Now, I do not want to put a versus on this because candle signs would have not been in existence if it wasn't for order flow. Everything I do was first of all based on fair value gaps. That led me to the understanding of order flow. Then from that understanding of order flow, it led me to the understanding of candle signs. So there's not one thing better than the other. If anything, it all started with fair value gaps. So the fair value gaps are the best. Now, again, the thing I want you to choose, I'm going to state some pros and cons. But before I do that, I want you to understand, you choose the one whichever resonates with you. I do not want you to choose one because I chose it or because another friend in the community chose it or because you think this one will give you more return, you think this one will give you a higher win rate. It does not work like that. Because whichever one you choose and whichever one you decide to stick to, that is the one that will give you a higher win rate and higher return, funny enough. Because if you stick to one and you study and you study and you fail and you experience it, that will give you the higher return, higher win rate. So stick to the one that resonates with you. And why is that? Because that will be easier to study, will be easier to master for you because it's more fun to actually look at. So here, order flow is pros, more detailed view because we can go into the lower time frame. Prevent losses more easily. So for example, right now I showed you a few wins mainly, but if you want to prevent some losses, then order flow is going to, of course, have a more detailed view. So you can already see it's somewhat coming. If we prevent or if we're not running highs, for example, in a bullish example, and if we're not running highs and we might be sweeping that, then we can simply decide to not enter. Where on candle signs, we might already be in that entry, of course. Then the cons right there, less opportunities and delayed break even. And I would as well add in the cons, it's more chart time. It's oftentimes as well a little bit more confusing because what is a good order flow setup? What looks very good? You would have to, we are running highs, we have the perfect value gap, etc. So it's a little bit more confusing oftentimes. But again, it gives you more detailed view. So I can 100% see as well if people like order flow entries more. Then right here, we have candle signs entries. Again, I have 1 to 2. It's not a hierarchy. There's not one better than the other. For candle signs, we have pros. Better entries oftentimes. It's more accurate entries. Then earlier break even right there as well. You can most of the time go break even a little bit earlier. Again, respective on the time frame you are looking at. So if we're comparing order flow and candle signs in the same exact example, then we might not be going break even a little bit earlier. But if we compare it relatively seen candle-wise, so not actually time-wise, then yes, we can potentially go break even earlier and a little bit easier as well. There's less chart time, and that chart time is super underrated because the more chart time you have, the more you are likely going to mess up as well, which is a topic we're going to go over later on. Then we have the cons right here. The cons is a less detailed view. Initial stop loss is more difficult. So we made it somewhat objective right there with you need to place above the rejection candle, but the rejection candle, what exactly is the rejection candle? That's a little bit more subjective. It's a little bit more difficult. So if you struggle with finding that, then I would advise maybe go for order flow. Maybe study both of them and see which one you are better with as well. More subjective is also another con for candle signs right there. More subjective is also a little bit younger. And what I mean by that, the candle signs entries are a little bit younger concept overall, just because, again, it's not because I'm throwing it out there. No, it's because my own understanding. I'm just sharing my own understandings because I'm trading. So since I'm trading myself, I can just share the discoveries as well that I come to myself. That's very important to understand. That's why maybe with time as well, you or I can also make it to, can also look into making it a little bit more objective. But again, more objective does not mean it's always better. I like subjective things as well. Then that leads me to the understanding of the practice right here. So which one resonates with you? That's an extremely important question to ask yourself. You do not need to make a decision in the first 5 minutes, but there is likely going to be throughout the video as well, just a simpler understanding on one of the two concepts. So order flow is better because you understand it more for you, or candle signs, you understand it more. Which one was easier to understand for you? Which one you just get a good feeling with it? You just get a good feeling with order flow or candle signs, and you see it very easily in your chart as well. Do you see order flow very easily, or do you see candle signs very easily in your chart? Perfect. That is the one that resonates with you. So the resonating part is again understood with easy. Is it easy for you to understand? Is it easy for you to actually apply it to the chart as well? Do you get a good feeling? Do you like using that? Do you like using order flow or candle signs? Stick to one of the two right there. Then stick to that one for a long period of time. And this is, again, extremely important to understand. Because if you're switching from order flow entries to now the next week you're doing candle signs entries, next week you're doing order flow entries again, that's not enough time to give it to be able to understand it fully, to get to the advanced understanding. So my advice, if you find one that you resonate with and you truly are convinced, I resonate with this. If you're not truly convinced on that, perfect. You can go study both of them and still get to that same understanding which one resonates with you. Once you get to that understanding, stick to that one for months and months and months and months. Study, 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 experience it, lose with it, win with it as well. From that, you will gain so much experience that you will get extremely good at that singular entry right there. Then study it to master it fully. Case studies, deep work sessions. Now, from there, of course, you can go my way, as in you can now work your way to different kinds of entries, but you first need to master one entry before you can move on towards the next entry model. I had mastered a delirium trading plan, which I'm also going to share later on in Spring Around. I had mastered that one. I had mastered order flow entries before I could allow myself to actually move on towards candle signs entries as well. That is extremely important to understand. All right, perfect. Thank you.